Oil crossed $90. The 30-year Treasury yield moved back above 5%, and traders increased the odds of another Federal Reserve hike in early Monday trading. Yet U.S. stock futures barely moved, while Bitcoin initially held near $65,000. The strongest reaction was happening in oil and bonds before appearing across risk assets. Is this genuine resilience or a warning that has not traveled through the system yet? The catalyst is renewed U.S.-Iran escalation around the Strait of Hormuz. Reuters reported that 4 vessels transited the strait on Sunday, down from 8 Saturday, through a route that normally handles about 1/5 of global oil trade. Brent rose above $90 for the first time in more than a month. That matters beyond energy because expensive oil can lift inflation expectations even after softer U.S. inflation data. The transmission chain matters more than the headline. Oil affects inflation expectations, which influence the expected Fed path and long-term yields. Higher yields increase the return available in bonds and raise the valuation hurdle for stocks whose profits sit far in the future. That matters for expensive AI companies preparing to defend enormous spending plans during earnings season. It can also reduce liquidity appetite for Bitcoin and other volatile assets, although that pressure remains unconfirmed. The mixed reaction is why this is not a crash call. Gold slipped as geopolitical risk increased, suggesting higher rate pressure was competing with safe haven demand, while Bitcoin remained about 4% higher over 7 days in the earlier snapshot. Those moves do not prove either asset is safe or that oil caused every market change. They show that investors were still separating an energy shock from a broader financial shock. Confirmation would mean oil stays elevated, long yields hold near their highs, U.S. breadth weakens, and Bitcoin loses resilience on meaningful volume. Invalidation would mean oil retreats, yields reverse lower, stocks absorb the news with healthy participation, and Bitcoin holds. The next signal is not another geopolitical headline alone. It is whether the U.S. cash session and this week's major technology earnings allow pressure in oil and bonds to spread. The calm verdict is simple. The market has repriced the inflation channel without confirming a broad liquidity break. Staying calm does not mean ignoring risk, and staying cautious does not mean predicting a crash. Watch the sequence. Oil first, yield second, then stocks and Bitcoin. Price is the surface. The message is whether liquidity follows.